Hello, and welcome to Everything Finance, where I help business owners get funding, startup business owners get funding, and also offer credit repair service to help not only business owners but regular people as well. So today's video is going to be about, are credit cards really worth it? Credit cards can both help and harm your finances. On one hand, they allow you to build your credit history so you can qualify for larger loans with better terms. Think auto loans and mortgages. Plus, many credit cards come with reward programs, and other credit cards can charge fees and amounts of interest if you fall behind on payments, making them financially dangerous if you're physically irresponsible. Before getting your first credit card, it's important to know what you're getting into so you can maximize the benefits and minimize the risk. Key takeaways are: credit cards can help your credit or harm it, depending on how you manage spending and payments. Not all credit cards are created equal. Comparing terms, fees, and rewards before applying can save you money and frustration. A secure credit card can be a smart way to establish credit for the first time or rebuild it from the ground up. Credit card benefits. A credit card gives you access to a revolving credit line, which lets you borrow money up to a certain credit limit. This is typically a significantly more convenient option compared to cash and other payment methods. Here are some other benefits of opening a credit card. Build credit. If you don't have a credit history or your credit is poor, opening a credit card can be a great way to build or rebuild it. The issuing bank will report your timely payments to the 3 major credit bureaus each month. The longer you keep up with payments, the higher your credit score will climb, up to the maximum of 850. Rewards and sign-up bonuses. Many credit cards come with reward programs. For example, Wells Fargo Active Cash Credit Card lets you earn 2% in cash on purchases. Other credit cards offer airline miles, discounts for certain spending categories, and or one-time sign-on bonuses. Cover emergency expenses. Credit cards can be an effective safety net for emergencies. If you don't have sufficient cash on hand, they can help cover medical bills, car repairs, and other unexpected expenses while you gather the necessary funds to pay the debt off. Important to note, any unauthorized charges to your credit card typically aren't your responsibility. Under the Fair Credit Billing Act, your liability is limited to $50, and many credit card companies go further by offering zero liability policies. This means if your credit card is stolen or otherwise misused, you won't lose any money. Credit card risk. All that being said, using a credit card also has some potential risk. For one, having constant access to credit in your pocket make it easier for you to overspend, which can cascade into further problems if you let it get out of hand. Below are a few additional risks to keep in mind. High interest rates. Most credit cards are unsecured, meaning they are not backed by any collateral. As a result, issuing banks tend to charge higher interest rates on outstanding balances. In March 2025, the average credit card annual percentage rate was 24.20%. That means if you held a 1,000 balance for a year, you would also owe about $242 in interest. Fees on top of interest. Many cards charge annual late payment, foreign transaction, and other fees. These can add up fast, putting a real cost on having and using a credit card. Damage your credit. Just as responsible credit card use can build your credit, irresponsible can hurt it. If you fall behind on payments or stop making them altogether, you can significantly damage your credit, hurting your ability to take out future loans. So, how to avoid credit card pitfalls. Don't let the risk scare you from opening your first credit card. So as long as you pay off your balance every month, you won't be charged any interest, and you can earn rewards and improve your credit along the way. The key is to spend responsibly and avoid common traps. 0% introductory rate, or APRs. Some credit cards offer introductory periods during which you are charged no interest, dependent on the lender. These can last anywhere from a few months to 21 months. This can be a great way to consolidate higher interest debt with a balance transfer. However, the introductory period ends and the regular rates start. You could end up with a high APR being levied on a large balance. Cash advances. Cash advances can be another trap for unsuspecting spenders. Essentially, they're a short-term loans are taken against your credit card's line of credit. You simply use your card to withdraw cash from an ATM. While this might seem like a quick and convenient way to get cash, the cost can add up fast. Unlike regular credit card purchases, cash advances start accruing interest immediately. There's no grace period. Furthermore, the APR on cash advances is often higher than your regular purchase rate, and most credit cards charge a 3 to 5% cash advance fee. How to find the best credit cards? Well, to get the best credit card for your financial situation, shop around, review, and compare annual fees, interest rates, late payment penalties, reward programs, and other credit card terms. Don't forget to also check whether the credit card will be accepted where you intend to shop. For example, Discover cards are accepted in many foreign countries. Now, in conclusion, my personal opinion on credit cards, you don't need credit cards to build credit. You can actually use jewelry store credit cards. If you go in and ask if you don't have any sort of credit history or a credit score or anything like that, just go to a jewelry store like maybe like Kay's Jewelers or something like that, or any type of jewelry store, and ask them, do they have any type of card or credit card, cards that they offer. They usually do. I know K's do. And basically, all you would do is go in, apply for one of those credit cards, get you some small, like a bracelet or something like that. That may be like $800, and you put it on that credit card, that store credit card that they gave to you, K's Jewelers in Nick's example, and you just make payments on it. You don't have to worry about APRs and all this other stuff. You just need to make payments on it. And once you make payments on it, they too also report to the 3 major credit bureaus. So you don't need a credit card to get credit. Now, for business, if you using the credit card for business and you using it for real estate or whatever type of business that you in, and it is of benefit to you, then yeah, go ahead and sign up for a credit card. For as far as that is concerned, in my personal opinion, personally, a regular person don't need $20,000, $30,000, $40,000 credit limit if they're not planning on doing anything business-wise with it in the first place, and it's just sitting there, and you just go and blow money on a bunch of dumb stuff. So, but like I said, anybody that's in business and real estate or what have you, they could take, maybe draw that credit line off of that credit card and put down on the house, fix it, flip it, sell, make a profit, and put the initial balance back onto the credit card and start again. So that will only make sense for people in that sense. I would say. Well, that concludes this video. Don't forget to like, share, and subscribe to the channel. Go to the links and check out the links below to see if any of them can help you in any situation that you may have. Until then, I will see you in the next video. Peace.